Hello and welcome to a brand new episode of Smart Money. Today on the show, we talk about what the various factors are that you need to consider before getting either a health or a term insurance plan, the do's and don'ts of insurance, and if you have any ailments like, say, diabetes, what are the insurance plans available for you? Joining me on the show today is Dheeraj Shegal, who's the Chief Distribution Officer at Bajaj Allianz Life. Dheeraj, thanks a lot for joining in.
Thank you so much.
You know, insurance is a bit of a tricky subject, right? A lot of people still don't understand it. So let's start with the basics. Let's try and differentiate between term life and whole life, term life insurance and whole life insurance, and who needs term insurance, who needs life insurance. If you can just, lay the groundwork for us.
Sure. First of all, Sonia, thank you so much for having me on the show and to pick up this ever so important topic of life insurance. I think COVID has made the need and the discussion more pronounced than it ever was in past. As far as life insurance is concerned, two cardinal fears that we all have in our mind is that what if I die too young? What is going to happen to my family and the financial liabilities and the responsibilities that I have towards my family as an earning member or as the breadwinner? And the second one is, what if I live too long? Am I going to survive on the savings that I have for myself and my family? And am I going to sustain the lifestyle that I have?
So either way, it's a problem, right? If
yeah, either way, it's a problem.
If you live too long.
Absolutely. And life insurance is one product which perfectly takes care of these two fears or concerns that we have. Coming to your question which you asked, what is the difference between a term insurance and a whole life insurance? Term insurance is plain and simple life insurance. Somebody buys a life insurance plan considering the future liabilities or the responsibilities that the person earning member has towards his or her family. What is the amount of cover which is needed? At what age is the person buying? Person buys the term insurance plan. God forbid, if the bread earner dies, family gets the lump sum amount so that they can take care of their future responsibilities. That's the term insurance plan.
In fact, we have a very helpful table here, the term insurance and whole life insurance, right? If you want to go through these one by one?
Absolutely. So temporary versus permanent means that if I am buying at a certain age, let's say somebody buys at the age of 30 and feels that the responsibility or the financial responsibility would cease to exist at the age of 65, then the person buys a term of about 30-35 years. Okay. Yeah, because at that time there is no financial responsibility to be met. Whereas whole life, if you see it is written as permanent, it covers the person till the age of 99, which means even after the premium paying term gets over, if something happened to the person who's buying the policy, the family would still get the benefits, the financial benefits which he or she had signed up for. So that's what the first 2 points, right? There's no cash value which gets accumulated in term plan. The family gets the money only when the death happens, the death of the family, the member who's bought the policy happens. Whereas in whole life, there is also an element of cash. You can accrue cash value over a period of time which gets paid to the family. So
when does it get paid to the family?
When the policy starts getting matured or the benefits start unfolding, you start getting those benefits.
But this policy, whole life policy, is like till
the age of 99. Yeah, so the family can get the benefit of both these plans. If I had to recommend, I would say that people can look at a combination of the two, term insurance as well as the whole life plan. In case of unforeseen death, the family gets the lump sum amount which comes from the term life side, and family can also continue to get the cash benefits which get accrued in the whole life plan over a period of time. So if there's somebody who's got a home loan and the EMIs have to be paid, whole life plan can take care of some of those things.
So these two have nothing to do with health, right?
These two have nothing to do with health, only to the level that they don't cater to the health insurance part of it. But while buying term insurance or whole life plan, it is very important to keep in mind that earlier the better, because of two reasons. One, if you're buying it early in life, you are able to afford a larger amount of cover in a limited amount of premium that you pay. As the age increases, the premium goes up and term insurance becomes slightly more expensive to buy. Second thing is, in the earlier stages of our lives, we don't have too many health conditions. and hence it is advisable to buy term insurance early on.
Earlier. Okay, let's go through that. Pure death benefit payout and death benefit payout guaranteed. What's the difference?
So pure death benefit payout is that whatever is the death benefit that you have taken, let's say somebody buys a policy which has a death benefit of 50 lakh rupees. The family, in case of the death happening in pure term life plan, family gets that 50 lakh rupees and the relationship with the insurance company gets over there. In the whole life plan, there is an element of death benefit as well as the guaranteed payout which is associated with the whole life plan. So the death benefit will come and you will also continue to get the benefits during the term of the policy.
And the final one, you want to go through it?
Can renew or convert, it simply means that, if I have taken a policy which covers me for a shorter period of, let's say, 15 or 20 years, I can either buy a new policy or I can convert that into a whole life plan. Whereas whole life plan covers you for 99 years, that really can't be converted.
Okay, all right. So these are the basic life insurance, the term and the whole life insurance, right? This is very helpful, actually. A lot of things that even I sort of needed to revisit. Let's talk about ULIPs, right? Because that is one slightly debatable investment because it mixes investment and insurance.
Yes.
So as someone, a lot of people believe that you should keep investment and insurance separate. But I want to understand both the pros and cons of investing in ULIPs.
See, ULIP, as the name suggests, if I expand that, it says unit-linked insurance plan. For a layman, it is an insurance where the part of money which is going towards your mortality risk, which is associated with the policy features, and large part of amount which you are giving is invested in markets, in the stock markets. The pros of buying this are, so for let's take two kind of customers. One is who's an evolved market investor. Let's say if you are an evolved market investor because you understand markets, for you the benefit of buying a ULIP is that you are able to switch your investments from time to time from one category of funds to another category of funds without any charges of switching. There is no tax implication. There is no entry load or exit load, and you can, as per your preference, as per your reading of market, you can switch your funds. However, if you happen to be somebody who does not understand the market so well, because of the long-term nature of life insurance savings, you can leave that money in the hands of experts and still enjoy the benefits of the returns which the stock markets are giving, without taking any added risk of making your own assessment and judgment on what kind of securities to buy. Okay. Life insurance cover comes at an added benefit on that. So those are the pros. I don't really want to call the other part as cons, but some of the things that you need to be watchful about. First thing is, please understand that it is a market-linked plan. And stock markets are subject to volatility. So there would be times when your investments would not be giving you returns as per your expectations. But it's a long-run plan. If you are holding your money in stock markets for a longer period of time, you're paying your premium regularly, you're getting the advantage of rupee cost averaging, eventually the plans would give you returns which are as per your expectations or doing as good as markets, if not better. So that's first thing, volatility of market you have to be comfortable with. Second thing is, which is true for all the life insurance plans actually, but more so for ULIPs, that the money that you're paying in ULIP plans is locked in for 5 years.
Yes. And that is my big issue with ULIPs. Why would I lock in my money for 5 years in equities when I have an option right there to invest in mutual funds, which is so liquid, I'll get my money the next day. So why should I make that lock-in?
Sonia, if you look at any of the market-linked instruments, longer you hold on to the investment, better are your chances of making better returns.
That point is taken.
Yeah?
That point is taken. But just the fact, knowing that my money is not available to me for 5 years, I'd rather just put it in plain mutual funds, right?
Look at it the other way. Use this as an opportunity to have a very disciplined long-term savings where even if you have that temptation to withdraw your money and put it in something else, or put it in another financial goal or aspiration that you have. This is something which is used for planned long-term savings to meet your life goals. So look at it as an advantage that you will have to hold that money at least for 5 years. It increases your chances of getting better returns because you know that over a period of 5 years, markets would definitely give you better returns. And it gives you the opportunity of having very, very disciplined corpus built for you.
Okay, well, there are several points that, to ponder over on ULIPs, right? Personally, I believe it's better to keep your investments and insurance separate, but there is a product for everyone in the market, I guess. Let me do one thing. Let me take a short commercial break. Many more questions lined up for you. Don't go anywhere. We'll come back and demystify everything to do with insurance in just a bit.